Hey everyone, Anthony Venuti with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about interest rates and products and why not every product and interest rate is created equal. We'll get into that and more. Stay tuned, don't want to miss this. Interest rates, and yes, interest rates. That is a very hot topic with any Canadian right now who has a mortgage, is looking to purchase a home in the near future, and more importantly, refinancing or restructuring, but even renewing your mortgage in the next 6 months to a year. Interest rates are at the forefront as affordability concerns are growing here in Canada, as well as the Bank of Canada's indication of further rate hikes in October and December, and obviously on the tails of a slightly lower inflationary number here for the month of August in Canada. A lot of questions on where interest rates are headed in the short term and long term are very important. And they are very important, especially for consumers and viewers that are online shopping for options, especially when you're looking online at these lower rate guaranteed type of lenders and websites. It's very important to distinguish what is being offered. And we will get into that because a client that came to us maybe about a week and a half ago now, we got the client approved. The client had reached out to us because they had a pre-construction closing that was happening in 3 weeks. And what happened was they reached out to their broker and the brokerage house and nobody got back to them. And they had a pre-approval with a rate, and obviously that had expired. So I said to the clients, I said, look, I think the best thing to do is for us to gather all your documentation. And they had sent it to all of us so that we can review it here at In Touch Mortgage Solutions. And we basically set up a follow-up meeting. We went through all the information and we found out the clients were self-employed. And obviously their income situation had changed since they had purchased the home. And obviously they had some difficulties on their finances over the last 2 years of what has happened here in Canada and across the world with the pandemic. So the clients were very concerned about qualification. Now, luckily, they had put 20% down with the builder and looking to get a maximum mortgage of at least 30 years. And when the client had basically came to sit down with us to go over the final documentation, they were saying, Anthony, look, we saw these rates online at this rate and that from here and here. And I said, that's great, let's take a look at them. And we went online, we went through some of them, and all those rates that were being offered were for insured mortgages for 25-year amortization and purchase prices less than $1 million. And I turned to the client, I said, look, so your purchase price is over $1 million. You need a 30-year amortization in order to qualify. And obviously you're putting 20% down, and that is basically pushing you out of this product and into a more conventional product. Not to mention the fact that to be insured or to obtain that rate, your ratios, servicing, gross debt servicing, total debt servicing numbers need to align to the bank and the insurer's guidelines, which they don't. So basically that client was under the expectation. That is sort of the purpose, the rationale behind this video is the expectation of the interest rate. What can or what will you be paying for an interest rate depending on your situation? And when we work with these clients, as I said, we got them approved. These clients were particularly adamant that they wanted a product with a line of credit. And once again, we referred to the lender saying, look, these rates that you were being quoted, they did not offer you a line of credit component. Now, there are some monobanks offering very aggressive rates that do offer a line of credit, but unfortunately, due to the requirements and the circumstances and the ratios, the clients were not eligible for that lender. And going through all that information with a professional, you sort of get to understand, and we show the clients exactly why that is. And the clients were saying, okay, Anthony, we want a line of credit. I know that we purchased this house. We have family coming from back home. We need to finish the basement shortly after moving in. And the clients were basically concerned with the fact that, will we be able to get them a line of credit? And because they're only putting 20% down, they won't be eligible for a line of credit at the current moment. But what can happen down the road is if values stay and they hold, then we can basically look to restructure that mortgage in about 6 months to a year and use the current market value. Because on a new construction purchase, like any purchase, even if the value of the home comes in higher, you cannot use that amount. We have to go by the purchase agreement and what the price was that you agreed to pay for it. Down the road, they can definitely look at those options for them, but basically looking at that product, understanding the differences and what is being traded off. So that is a very important topic when you look at some of these online lenders that are offering these aggressive rates, you may ask yourself, who is this lender, right? Or what is their options? They might be something that you're not very comfortable with. They might be strictly online, but it's very important to understand what you as the consumer are looking for in your product. And a lot of times we'll talk to clients and we'll say, hey, you want this aggressive rate? We can offer it. It's with this lender. And that client will turn around and say, well, who's that lender, right? Like, what is your comfort level with working with that lender? And more importantly, what are you giving up? That is the question. When you start to work out the scenarios and present the client with, hey, this lender is offering you a cheaper rate, but your prepayment privileges are much lower. You're in a bona fide sales clause. There are higher stipulations, higher penalties to get out of this mortgage, as opposed to maybe a little bit higher of a slightly higher interest rate, but you're going to get higher prepayment privileges, more flexible penalties that are cheaper than top 6 banks, for example. And you're able to basically maneuver that product within that lender, even if they don't offer a line of credit. Now, there's a lot to unpack when it comes to these types of lenders, and to do it in a short video would not be doing it justice and probably leave you even more confused than when you started watching. So what we want to do is basically look at where interest rates are right now, so that if you're out there shopping for a mortgage, whether it be a renewal, whether it be for a new purchase or refinance or restructuring, you can have a little bit better of an understanding. Now, one easy way is you can download our app in the description box below and play around with our Canadian mortgage app, and you can go through some of the rates there. But if you look at this chart here, you'll see that insured mortgages, which are those that are around 25-year amortizations, purchases below $1 million, and obviously client paid insurance premiums, these products can range anywhere from 4.39% all the way up to 4.89% this week. And obviously these are great products if you fit those requirements. And generally these are the types of rates that you're seeing online. And obviously the variable rate products are equally as aggressive. And these are for, once again, insured mortgages. Now, insurable mortgages, something we've talked about on this channel many times, are products that are 20% or more down as well, but you can basically get a better rate depending on how much down payment you're putting. Obviously, if you're putting more than 35% down, you will see and you will be eligible for better rates. The less you put down, the more risky the deal is to the lender. Obviously, the higher the rate is. Now, let's take that into consideration when you look at a conventional mortgage. Why is there such a disparity between a 30-year amortization and a 25-year amortization when it comes to rate? And generally speaking, lenders will advise that any mortgage that is 20 to 35% down is the most riskiest. Not to mention, obviously, less than 20% down, that's why it's insured. So those premiums get added onto conventional 30-year amortizations. And to simplify the process, that is because these mortgages remain on the lender's balance sheets, as opposed to insured mortgages that are basically insured and it is an asset rather than a liability. So conventional products can range anywhere from 5.29% all the way up to 5.5% and higher. And obviously those are for 30 amortizations, and you can see that the variables are right in line with that, and obviously depending on the type of product. Now, obviously understanding your limitations and expectations of that product are very important. How long you plan to stay with that lender, how long you plan to keep that mortgage there. Are you a person that wants to jump around? Are you more aggressive on the interest rate or the product? It all depends on what you need. A lot of times we'll have clients that reach out to us after the 5 or 10 year mark, and they'll say, I was offered a renewal, and we'll be able to basically look at some other options, say, hey, we can beat that renewal rate. However, it might be 5 or 10 basis points, but you need to undergo new qualifications in order to switch that over, as well as you need to requalify, and potentially, you might pay legals and appraisals and so on and so forth. And by the time you add up those costs and that 10 basis points, you may or may not break even. So doing a cost benefit analysis in these particular situations, especially if you're approaching a renewal, very, very important. And I think it's always worth a conversation with a mortgage professional to see what is best and what options you have available. So we'll leave the video here. And once again, if you do enjoy the content that we're producing here at In Touch Mortgage Solutions, please feel free to leave those comments in the comment section below. Don't forget to hit the like, share, and subscribe button, and let's get this content out to as many Canadians as possible to continue spreading financial literacy and financial awareness when it comes to mortgages and real estate and everything in between. So we'll leave the video here. Thank you again for watching. We hope you enjoyed our Finance Friday video. Thanks for clicking and have a great weekend. We'll see you next week.